All right, hello everyone. Happy Monday. It is a new week of trade for the market, a new week of trade for Derrick himself. We are here with Derrick Oldensmith, the leader of T3 Live's ProDesk virtual trading floor and a professional prop trader with T3 Trading Group. I'm Greta Wall. I'm your host of these weekly market check-ins. Today we will be talking about the big topic of the week, which is of course Nvidia's earnings that are coming up on Wednesday, but also some other important numbers coming up later in the week as well. Quickly, here's a look at the current positions Derrick is holding, as he is a registered professional trader with T3 Trading Group. We just must disclose these. All right, so Derrick, before we talk about Nvidia, how is your new day of trading going today? It's a new week. It's the end of August. How's it going?
Fine. Little bit slow. We had Jackson Hole on Friday, which was exciting, but not exciting at the same time. Like, it didn't really translate into a massive amount of market action. It gave the Russell a lot of relative strength. So we saw a little bit of the resumption of that rotation trade that we had been seeing back in July with the IWM relative strength and QQQ relative weakness, off of a focus on interest rate cuts, with Jerome Powell basically taking his victory lap and saying, I did a great job, and now we can start to lower interest rates again. So a lot of outperformance from the Russell that's continuing through to today's trading session. So I've been, a little bit more bearish on the QQQ side, a little more bullish on the IWM side. At one point, very early on Friday, I said, looks like there could be a great pairs trade here of trying to be long the Russell versus short the Qs. So that's continuing to play out. But then the next stage of that is really going to be what you just said. It's going to be Nvidia's earnings on Wednesday, and we'll see what happens.
Okay, so here's a look at the numbers that are expected for Nvidia's earnings report. The chipmaker reports earnings after the market close on Wednesday. Expected revenues 28.72 billion, which would be up 113% year over year. Our earnings are expected to come in at 65 cents a share, up 141% year over year. And a lot of the focus, of course, will be on discussion over the Blackwell processor delay. And then what does Jensen say about the future of NVIDIA and AI as a whole theme? Because, NVIDIA is obviously the leader in the AI space and kind of the I'm not going to be able to remember the word right now, but the barometer of, where the AI space is going, and a lot of it relies on NVIDIA. So what are your expectations for the earnings report? Do you have any plans to play anything heading into the numbers? And what are you focusing on as a trader when this report comes out and when the press conference starts after hours?
Sure. So NVIDIA is going to be interesting. We've already seen the earnings reports from all their big customers, right? Microsoft, Google, like the main customers that are enabling all this NVIDIA growth. We've already seen their reports. So the market should have a general idea, just knowing what the spend from those companies is going to look like on what NVIDIA has the capacity to report. At the same time, NVIDIA's had this incredible snapback from that Monday low of about $90 just a few weeks ago, all the way back to 130, where it's been hovering underneath $130 for the last 5 days. Has been a really big level for NVIDIA. Tried to break out through it again this morning, but failed, along with some QQQ weakness. So paying attention to NVIDIA 130 as we're in front of the number. But then after the number, all bets to some degree are off, because you never know what companies are going to report. I actually think the risk is to the downside. I've been saying that with pretty much all these Mag 7 companies on their earnings reports, just because the price movement into the reports have been so lofty. And a lot of times that means that like a good earnings report is not good enough. I wouldn't be surprised if NVIDIA just came in line with things if they sold the stock back down. That's what I'm looking for. Trading NVIDIA itself will be very hard, but NVIDIA is so important that's going to affect the entire market. So you might be able to take some S&P put spreads into the report, something like that, to be able to capture some market downside if NVIDIA fails. So that's one thing that I'm potentially thinking of looking at. At the same time, I'm leaving for vacation on Friday, and I'm going to be gone for 2 weeks. And I am in a really bad habit of leaving for vacation with a ton of positions on, and then trading every day and managing my positions throughout that vacation. So I'm trying to do my best work right now to limit the amount of new exposure and new positions that I put on in front of a trip, so that I can actually have some peace of mind when I'm away, and rest a little bit more than I typically do. Because, it doesn't seem to matter where I am in the world. If the market's open, I'm opening up that laptop and managing positions and putting trades on. And I'm not going to go home flat. I don't think I've gone home flat in, 7, 8, 9 years. But I want to reduce my exposure to so little that it's an afterthought, which for me means leaving on Friday morning. Nvidia earnings are Wednesday night. It gives me Thursday to day trade a little bit if I want, but I don't want to put myself in the position where it's like I'm managing what is a multi-day game planning process off of a Nvidia report. So that's where my head's at. My head is, how am I going to enjoy my vacation the most?
That's great. That's great. When it comes to a report like Nvidia, in the past, we've seen, of course, monster moves from this stock in response to earnings reports. And that, of course, as you mentioned, Nvidia is kind of the market right now. So that impacts the whole broader market quickly as well. We can get these big spikes and drops after hours on a report like this, and then things kind of tend to level out when more normal market action starts the next day. Do you see yourself being active in the after hours session on Wednesday when it comes to responding to Nvidia's report?
It depends what I see in the report. If there's something that's really exciting in one direction or the other, then there's a good chance that I trade it after hours. If everything looks like it's in line and trickier to me, then, or it's a little bit more mixed, then I might say, hey, I don't have as much of an advantage here. I don't take a half step back. I always want to pay attention to what the options are pricing for the move, because I find that those are two immediately important levels. As soon as the report comes out, if it gets to the downside, options expected move, or the upside, those are important points to pay attention to. And then beyond that, the initial trading is tape reading for me. It's really trying to identify those natural buyers and sellers that I'm seeing in the market, in conjunction with understanding what that news actually looks like, to create a thesis or a thought process for trading as I'm seeing, the buyers and sellers actually kind of come in. Which I remember with SMCI, somewhat related name, not as hyped as Nvidia, but definitely a lot of hype around it. I remember when that SMCI report came out, all the numbers immediately look good, and you see the market uptick. And I just remember seeing that gross margin number and being like, that's a big miss on a margin number. Usually you don't see really, really big beats or misses on margin numbers like that. And I thought maybe that could hit SMCI back down. And the next thing you know, SMCI starts ripping lower as the rest of the market kind of digested that. So I pay attention to those numbers as they're coming out, because there's clues in there, just like there was with SMCI. Beats on everything, but huge miss on that margin number. Immediate spike leads to a full failure. So I pay attention to what that news is looking like in conjunction with what the price action is actually telling me, which again, within the first 5 minutes of the report coming out, there's not really any levels to look at outside of, again, knowing the options move. So it's just about trying to identify how buyers are buying and how sellers are selling in the level 2. And that's one of the times in which the tape tends to trade a little bit more pure. One of the issues is someone who kind of, grew up in a world of tape reading and level 2 reading for trading decisions, is that the algorithms have gotten so good at confusing the information in level 2 and hiding the important information in level 2 in the tape, that advantage most of the time is not there in the same way anymore. But then when you actually get an earnings report, a lot of times those black boxes are turned off because they don't want to get caught on the wrong side of that exposure immediately after a news event when there's less liquidity. So the people who are in the market at that point in time actually tend to, as a higher percentage now, be human beings. And that just makes the price action just much more readable. So that's what I'll be looking for.
When it comes to what's this report, the lead up into this report has been obviously an abnormal August. We had, the huge market crash at the very beginning of the month, and then this huge recovery rally, the Dow hitting a new record this morning before, things kind of now are struggling in today's session. But just this huge comeback rally that we've seen. Do you think that sets up Nvidia for a different response than maybe would have happened if we'd had a typically seasonally slow August when this report was coming?
Yeah, I mean, absolutely. So first of all, when it comes to slower market periods of time, like the August to beginning of September period, or some of the holiday sessions at the end of the year or around Thanksgiving, most of the time the price action will be very slow and boring. But if something happens, if an event happens that juices the price action, it actually has the capacity to then be even more crazy than it would otherwise, because there's so much less liquidity in the market. So there's so many less traders around. So a lot of times that less liquidity, less traders just means that you're looking at a flatlined market with nothing to do. But in other times, if an event happens, you could be ripping higher, ripping lower, and in some ways it creates even more trading opportunity than there would be otherwise. And that's pretty much what August has been. But to directly answer your question, going into Nvidia reporting at $90 versus going into Nvidia reporting at $130 sets a different bar for what that earnings report needs to look like. After you just pulled back from 140 to 90, if we went into this report when it was still at 90, the bar would be much lower. And maybe if you had like an inline earnings report, you could go up. And if you had a beat, you could go up a ton. And if you had a miss, maybe the damage isn't going to be as much. Back at 130, we're not at all-time highs here, but we've just recovered a lot over the course of a few weeks, like you were saying. Back at 130, that bar has changed. So at these prices, I'm more inclined to think that an inline number means potentially it's a sell the event. A beat has to be a really good beat in order to propel the stock higher. It can't just be a little bit. And a miss becomes a big problem for Nvidia. And then that extends to the Qs and Mag 7 and to some degree the S&P as well. So again, you never know what a company's going to report in earnings. And even if you did, you could never even know perfectly what the reaction was going to be. But I'm inclined to think that the risk is to the downside at $130 as we come into this report.
All right. Other things coming this week, we do have some important economic numbers, but these might not be as important as they used to be based on Powell's comments last week. So we got consumer confidence coming tomorrow, then on Thursday, jobless claims and the final Q2 GDP revision. And Friday is the Fed's preferred inflation gauge, which is the PCE price index. But Powell basically told us last Friday that inflation's fine, whatever. We're focused on the labor market. Are you focused on any of these numbers and expecting anything to be market moving, or is the market itself also going to be really just focused on the labor market at this point? Because that's what the Fed cares about.
Yeah, so obviously jobless claims is important, and anything with jobs related is going to carry increasing importance at this point. We're pricing in a 35% probability of a 50 basis point cut. So these numbers are really important still, all these economic numbers that are coming out. And that includes the GDP revision, anything that can give us a look at the strength of the consumer, jobs obviously being really important, because that's all going to play a hand into, is there any chance of actually getting a 50 basis point cut? And while the market says right now, yes, there's a chance, I'm inclined to say that there is no chance. So I would take the under on that currently with what's going on right now. Everything's been good enough. There's no emergency out there where we need emergency cuts or 50 basis point cuts or anything. One of my traders made a really funny comment when the Qs were selling off at one point today. He was like, emergency cut, we need the emergency cut. So people like to freak out about everything these days. But I'm of the opinion that the Fed is going to take things slow and steady here. And Powell did a victory lap. But I think that victory lap at this point actually makes the risk of the first cut also to the downside. Because, again, the market's overly pricing in my opinion, the amount of cuts that we're going to get at this point. And it really begins to bring the risk to the downside. So we'll see how it plays out. There's a good chance that it becomes a sell the news event. But here at the end of August, we're still relatively bullish. There's a lot of inflows coming in.
Let's talk a bit about the Fed and what we heard from Powell last week. He kicked off Jackson Hole on Friday, and then the symposium, of course, lasted through Saturday. But, the big takeaway from Powell was he did come out pretty dovish. I know ahead of time you were expecting him to be a little bit more hawkish than the rest of than a lot of people were. But I think his message was very dovish. The time has come for policy to adjust, and he really left the door open for multiple rate cuts. Did say, of course, they will remain data dependent, but as you said, took the victory lap on inflation. So, we've got things under control. Inflation is moving in the direction we want, but we definitely can't afford any more weakening in the labor market. So they're focusing on the jobs at this point. As you mentioned, FedWatch is pricing in a 32.5% chance of a 50 basis point cut. Of course, the majority is still leaning toward that 25 basis point cut, but the chances of that 50 basis point cut, or the expectations for that, are rising kind of daily at this point. And the market is anticipating 3 rate cuts by the end of the year, for at least 75 basis points, but some say a whole basis point after Powell's comments. So when it came to Friday session and Powell speaking, what was your reaction as a trader as you were watching the market reaction, and how did you navigate it? And what do you think? You can expand a little more upon your thoughts on what Powell had to say.
Sure. So I thought on that event also that the risk was to the downside of him coming out more hawkish than the market expected, because going into that, the market was pricing in a similar percentage of a 50 basis point cut. So the percentages of cuts for September and throughout the end of the year, and it's near a full 100 basis points from now through the end of the year. That expectation really didn't change at all on Friday. The interesting thing was that Powell came out about as dovish as he possibly could have been. And I thought that overall the market reaction was fairly muted. You did get a really strong bounce back in that Russell trade that had some degree of similarity to what we saw with that big boost higher in July. But the Qs and the SPYs were much more muted. I mean, the Qs gave an inside day on Friday. They were inside the range of Thursday's trading session, which was such a big hyped event. To get an inside day, it means that the market didn't take away too much from what Powell actually said. And it goes back to what I was even just saying about September, where if Powell just came in and he was as dovish as he possibly could have been, and yes, the IWM did rip higher, which is generally what I'm looking for anyway, but the SPYs and the Qs gave inside days. Even if the SPYs closed at highs, it was still an inside day. It wasn't like there was a massive outlier upside trading session across the board off of Jerome Powell taking a victory lap and coming out as being extremely dovish. So what I learned about trading a long time ago is when the reaction to an event should be something and it's not, a lot of times that's a signal in and of itself. You would think, if you're maybe not like a day-to-day trader or you're not following the market super closely, that Jerome Powell getting on stage and say, hey, we won, we beat inflation, we're ready to cut. What should that do? Like everything else held equal, if you're in a perfect classroom style setting, the market should go through the roof on that. But it didn't. Like I said, it was an up day. There was good rotation to the IWM. A lot of stocks overall did perform well. But the things that performed best were really the things that are most shorted in the market right now, not necessarily the things that are going to get a lot of more new long exposure coming into them. And that's why you can look at the Qs and you can look at the Mag 7 stocks and you can see a lot of these things really didn't trade well on Friday. So if Powell comes out and he's dovish as he possibly could be and the market can't go up, well, what happens if even just one thing at this point doesn't go perfectly? Then to me, that means that there could be a bigger move to the downside. So it's funny because, I think I have a reputation for being kind of generally the optimistic bull. And that's actually where I prefer to be. That's my happy place, is when the market is trending higher and everything looks rosy and I can, follow that trend higher. And, while we are a hair away from all-time highs here, I would say that my broader picture outlook for this market right now over the course of the next couple months, really, especially after we get through this week, is kind of neutral at best, especially once we can get through the period where a lot of these forced systematic fund flows that are coming back into the market over the course of the last couple of weeks, and that should extend through this week, especially as that begins to fulfill itself. You start to lose that underlying bid a little bit, And then if the market's pricing in a perfect situation and you don't get it, there just becomes more risk to the downside. So, I'm pretty big picture neutral right now, which for me, that means it's a great time to take a trip and go on vacation, because I don't want to overly push things to the long side right now. I don't want to overly push things to the short side right now. I want to get through this next month or two, really, and then, assess the data as it comes at that point.
You are going to be on vacation for the jobs report next Friday. We'll get the August jobs report next Friday. So you won't be here for the session, but do you think that the pressure is on for this jobs report to really come through for the market, or they're cutting no matter what? It doesn't really matter in the market. It's not really an event for the market.
They're cutting no matter what. It just can't be a disaster. If the report's like a real disaster, if it's a real major miss, then maybe there is a chance that we can actually get that 50 basis point cut. But I think that, traditionally markets want the Fed to intervene, because when the Fed is intervening, you get the Fed put, and it's really difficult for markets to go down. But you don't want, if you're trying to be bullish on this market, you don't want there to have to be a situation where you have to do emergency rate cuts, or you have to do these 50 or 75 basis point cuts, because that means that you're going into a real economic nightmare situation. And then it's, even on a 25, 50 basis point cut, at that point, then it's very obvious that the Fed was behind the 8 ball, and it's too little too late, unless they're doing something that's so emergency that's also disruptive to the market. I mean, we saw what happened with this mini blow up that we just had a couple of weeks ago. And that's just on the anticipation that the Fed's going to begin to cut, when at the same time Japan decided to tighten. So you don't want fast, violent moves from the market. So as long as there's not a disaster on that number, then we can begin to go into a moderate easing cycle for the Fed. And that, I think, is your more Goldilocks situation. The market continues to hold up fine. People are working, but inflation's come all the way back down. We can provide a little stimulus for the market from, some small incremental cuts over time, and let the Fed kind of do its job. And I do think I got to give Jerome a lot of credit, because I think that he did a fantastic job overall. It was probably a little bit late to begin the hiking cycle, but overall, over the course of his time as Fed chairman, he's done a pretty good job to oversee one of the biggest spikes of inflation, probably the biggest spike of inflation that's ever happened in my lifetime, to be able to get it back down, even if, probably a lot of that had to do more with supply chain economics and the Fed raising rates. He still, I think, deserves some credit for staying the course and, staying with what he has always said that he was going to do. He's just been very consistent with his message, and he deserves a lot of credit for that.
With the Fed rate cut, pretty much definitely coming September 18th. Most people I talk to, other traders at T3, most of you are saying at this point that you expect it to be kind of a sell the news event. A lot of this is baked in. We know the rate cuts are coming. It's not a surprise. So, some people, lay people may say, oh, cool, the market's going to rally because the Fed is cutting rates finally, and they've been wanting this. But when you look at the market and you look at especially the action over the past month since the beginning of the month, we've had this huge move higher. And so we know the rate cuts are coming. It's just when exactly are they going to start? And now we know, we're going to start September 18th. How baked in are those cuts, and what is the risk heading into year end with the possibility of 3 cuts coming before the end of the year?
Sure. So historically, you do see a lot of times on the first cut that it is a sell the event. But most of the time when the Fed is beginning to cut rates, it's because we're going into a hard landing economic scenario. And that's not what's happening here. We're beginning to cut rates when we're kind of coming into more of a soft landing situation. So while it's potentially a sell the news event, and I don't think it's a buy the news event, I also don't think that this is the beginning of some sort of big bear market that's coming into the market either, which again, kind of circles back to me having a little bit more of a boring stance on the market right now, where I'm just a bit more neutral. I can't possibly be an outright bull right now. And I think that the market has overpriced in these cuts, and certain parts of the market seem to be a little bit expensive to me. But I can't be an outright bear either. I don't see a recession coming on the horizon. People are still working. People are spending. The economy is strong. So it's overly priced in at this point, which can create at least some sort of a short-term sell the news event effect, unless they price that in between now and the Fed decision in September, which has been what I've been thinking is going to happen, but it hasn't happened yet. And that's it. You know, they sell us down a little bit, or at a minimum, they don't buy us up. But I don't think we're not cutting because there's a financial crisis ongoing like we were in 2007 and 2008. We're cutting because the Fed accomplished their mission. They got interest rates down to 2%. There's a couple little things to worry about with jobs, but it's not a problem. And then that's it. We take it from there.
All right. Apologies about my dogs. All right. So Derrick is, of course, a real trader, so we need to let him get back to trading. He's only got a few days left till he goes on vacation. So I want to give him full advantage of all these days. So that means Derrick and I will not be here next Monday. Of course, it's Labor Day, so the market will be closed, but also the following Monday. So everyone wish Derrick a great vacation. Derrick, I wish you a great vacation. But if you are interested in learning more about prop trading, working with Derrick, you can go to t3live.com/DOLive to get his free ebook that is about the benefits of prop trading and what it takes to be a prop trader. And you can learn more about that and how you can work with Derrick and T3 Trading Group there. All right, Derrick, have a great vacation. Have a great rest of your day. And everyone else have a great trading day as well.
Thanks, Greta. I'll see you in a few weeks.
All right, bye.